January 5th. Bank of America publishes one number, $309 silver. Wall Street laughs. CNBC calls it clickbait. Everyone moves on. Nobody read page 47. Because 309 isn't a prediction, it's a formula. And this formula has broken markets twice in modern history. First time, 1980, Texas billionaires cornered the system. Exchanges literally stopped functioning. The government changed the rules mid-game to prevent total collapse. The second time, it's unfolding right now. And Bank of America just handed you the exact playbook. I have the full document. 73 pages, signed by Michael Widmer, head of metals research at BofA. What's hidden in the methodology appendix will keep you up tonight. Here's what mainstream media told you. Bank of America predicts insane silver price. Ignore it. Here's what the report actually contains. 3 mathematical scenarios based on a proprietary analytical framework they've used internally for decades, the gold to silver ratio. And in their maximum stress scenario, what they internally code as the 14-to-1 compression event, silver hits $309 while gold trades at $5,000. That's not speculation. That's mathematical output from quantitative modeling using documented historical ratio behavior as inputs. Wait, this is where it gets disturbing. The report dropped January 5th, before China announced export restrictions cutting off 60 to 70% of globally traded refined silver, before Trump's conditional tariffs on Europe created barriers between London and New York silver markets, before the U.S. Mint repriced silver eagles at $173 while paper markets quoted $90, before the Fed started emergency repo injections during December silver volatility. The conditions Bank of America modeled as theoretical scenarios, they're manifesting in real time as actual market structure changes. The roadmap they published as possibility is becoming reality, and the banks know it. Stop. Let me show you what nobody's connecting. 1980, Nelson Bunker Hunt and his brother William, 2 Texas oil billionaires, they start accumulating silver in 73. Not paper contracts, physical bars, delivered to vaults in Switzerland and New York. By 79, they control 130 million ounces, 1/3 of all privately held silver on Earth. They're not speculating. They're cornering the market. They are forcing shorts to either deliver metal they do not have or cover at whatever price the hunts demand. Here's the mechanism most people miss. The futures market operates on fractional reserve. Open interest exceeds physical inventory by 15-to-1. Under normal conditions, this works because traders close before expiry. But when large holders demand actual delivery, the system breaks. January 1980. Silver peaks at $49.45, gold at $8.50. The ratio compresses to exactly 14-to-1. Exchanges panic. They implement Silver Rule 7. January 21st. Trading restricted to liquidation only. No new buying permitted, only selling. The hunts are forced out. Silver crashes from 50 to 10 within months. But here's what matters. The crash wasn't because silver was overvalued. It was because the exchange changed rules to protect member firms with short positions from annihilation, regulatory intervention to prevent market mechanism from completing price discovery. That's the 14-to-1 scenario. System failure requiring emergency intervention. And when Bank of America models $309 at 14-to-1 compression, they're not saying fundamentals justify it. They're saying if system failure mode activates again, that's the mathematical outcome. Now fast forward to today. Are we seeing conditions that could trigger 14-to-1? Watch this. Monetary crisis, check. Federal debt exceeds $36 trillion. Annual deficits locked above $1.5 trillion. Fed forced to ease despite inflation because debt servicing costs become unsustainable at higher rates. Real rates barely positive. Currency debasement accelerating. Supply shock check. China cuts exports. 60 to 70% of globally traded refined silver restricted for domestic use starting January 1st. Trump tariffs create barriers between major markets. COMEX registered stocks down 70% since 2020. U.S. Mint charging $173 for coins, while paper quotes $90. Short squeeze setup check. Bullion banks maintain net short positions exceeding 275 million ounces, according to CFTC data. Physical delivery demands spiking. Fed emergency repo lending in late December confirms major banks needed billions during silver volatility. All 3 conditions, simultaneously, exactly like 80. Except this time there's no Hunt brothers. This time it's structural. China's policy isn't reversing. Trump's tariffs are tied to Greenland, which Denmark will never sell. Industrial demand for solar and EVs isn't discretionary. The 14-to-1 scenario isn't theory anymore. Here's what the banks are doing while telling you to ignore 309. COMEX raised silver margins twice in 48 hours late December, not to cool speculation. To ensure banks with short positions can meet collateral as prices spike. Margin hikes protect shorts. Fed repo facility usage exploded past 40 billion, coinciding exactly with silver volatility. Banks needed massive overnight funding for margin calls. The Fed provided it, backstopping institutional shorts while claiming market stability. Gold to silver ratio options volume surged in January according to CME data. Institutions buying volatility, positioning for ratio movement. But public research still publishes bearish silver calls. Tell retail it's going down while institutional desks hedge for up. Classic. Bank of America didn't just model the extreme, they modeled the progression. The pathway from current 59 to 1 to potential 14 to 1. 3 waypoints. First, ratio compresses to 47 to 1, the 20th century average. If gold holds 4,600, silver reaches 98. This is mean reversion, not crisis, just normalization. Probability, 60 to 70% over 2 to 3 years. Second, ratio hits 32 to 1, the 2011 bull market level. If gold's at 5,000, silver reaches 156. This requires genuine precious metals bull market. Investment demand layered on industrial demand. Probability, 30 to 40% over 18 to 24 months. Third, maximum convexity. Ratio compresses to 14 to 1, gold 5,000, silver 309. System failure mode. All 3 patterns simultaneously. Probability, 5 to 10%. But if it hits, institutions positioned for it make generational returns. Everyone who dismissed it as clickbait watches from the sidelines. The roadmap is real. The formula is verified. The scenarios are quantified. Whether they activate depends on market dynamics. But here's what you're not being told. The triggers are developing faster than anyone anticipated when this was published 3 weeks ago. The gold to silver ratio just broke below 58 for the first time since October. COMEX registered inventory dropped another 2 million ounces this week. Shanghai premium over COMEX hit $12 yesterday. The progression isn't theoretical anymore. It's measurable. It's happening. $309, not a prediction. A scenario. A maximum convexity event that's occurred before and could occur again. Bank of America showed you the math. The triggers are developing. The question isn't whether you believe it. The question is whether you understand the mechanism well enough to recognize when it's activating. Because when the 14 to 1 compression begins, it won't wait for you to catch up. It will just execute the formula. The people who read page 47 will be positioned. Everyone else will be reading headlines, wondering how they missed it.